Hello everybody and welcome to my channel. In this video, we are coming to learn how to calculate number one, interpret number two, and then analyze financial ratios. So in my previous video, I demonstrated how to use these ratios to build a three-statement financial model, and I made it clear that it is worth noting that understanding financial ratios and how they are calculated and interpreted are key in analyzing any financial statement. Therefore, in this video, we are coming to learn how to do just that. Alright, so we have financial ratios. Now, financial ratios are actually some key performance metrics in accounting that we use to analyze and interpret financial statements. So financial statements as they are actually meaningless unless they are analyzed using these financial ratios that we have. Now, what are the purposes of ratios? Now, the purpose of a ratio depends on the user of the financial statement. So who is the user of that financial statement and what is the user interested in? Which of the figures, which of the line items is that particular user interested in the financial statement? So we have some users of financial statements here. We have management, we have suppliers. So all these people use the financial statements to make decisions. So with the help of ratios, these users can be able to analyze and interpret the figures in the financial statements to suit their need. So management, for instance, can use the financial statements to determine how to control their cost, because management, as we know, are interested in the profits of the firm. So they might be interested in knowing how to control costs in order to maximize revenue and hence maximize profits as possible. So they might also be interested in profitability analysis. So they might also be interested in the profitability analysis of the firm. And then we also have another group of people here. We have suppliers or lenders. So lenders will be looking at the credit worthiness of the business or the company or the firm, and so they will be interested in how quickly the firm will be able to pay their debt or to be able to repay any lending they make to the firm. And then also we might also have shareholders or even investors, and they might also be interested in analyzing financial statement to determine whether they want to buy shares in the company, whether they want to hold on to their shares in the company, or whether they want to sell their shares. So all these things come to play. Employees might be looking at the going concern of the company and how profitable the company is going to be in the future, so they can be able to pay their salaries and other benefits. So that is the purposes of financial ratios. And then we have the issue of comparison. So financial ratios by themselves do not actually make sense unless they are compared in a particular way. So we can have a ratio for a current year being compared with the ratio of a previous year. So that is it. Then we can also have the ratio of one company being compared to a similar company or a competitor. We can also have the ratio of one company being compared to an industry average, an average within the industry. So let's say uh, a bank, one bank which is doing very well is being compared with a similar bank. So such things can be done, and that is when we actually know the value of ratios. And then also we can also analyze ratios by comparing them with some forecasts or a budget. So those are some of the ways that we can do comparisons. Now then there comes the issue of factors that usually influence this ratio analysis. So we can have business factors such as type of business. So is it a retail firm or a manufacturing firm? And we know that with retail firms, a retail firm can actually have um, a very high revenue level, but their margin level might be lower because due to high levels of costs of sales and that kind of thing. And then you can also have the type of management, where management is very um, good, where the management is very good, that can affect the profitability of the firm because they will be better managers of the capital of the firm, and so they will do everything possible to be able to maximize the profits of the business. So all these things affect how ratios are interpreted. And then ratios, as good as they are, also have limitations. There are actually a number of limitations of um, ratios, some being the historical cost basis of the ratios analysis, which means that we know that financial statements are usually prepared on a historical cost concept. So most of the figures in the financial statements are actually um, historic or historical cost on a historical cost basis. They are valued on historical costs. So that is what makes it, even though it makes it reliable, their relevance is actually undermined. So that is what we mean by some of the limitations. And then we also have comparison issues where a business is being compared with another business that are actually not related. Let's say a business with a very high growth prospect being compared with um, a business that is already established in the industry. That can also be very misleading, or it might not make a lot of sense. And then we also have another limitation which applies to consolidated financial statements analysis. So what we mean here is that sometimes um, the poor performance of a subsidiary might be masked in the consolidated financial statements. For instance, where the sub has a very high gearing ratio, whilst the parent is having a very good gearing ratio, the in the consolidated financial statements, this because the parent obviously has a higher control over the sub, its gearing ratio will overshadow that of the sub, and so that can be problematic in ratios analysis and interpretation. Alright, so those are some of the few um, limitations of ratios that we have. There are a whole lot of them, so they are worth exploring. Alright, so in this video, what we are coming to do is we are coming to learn the 5 main categories of ratios, how they are calculated, interpreted, and how they are analyzed. Now, I want to stress on the fact that there is a difference between ratio interpretation and analysis. Interpretation, you are just talking about what the ratio is measuring. So by analysis of the ratios, we are talking about what impacts the ratio and what the ratio can impact. So what can influence that ratio and what that ratio also influences. So that is what we mean by analysis. So it is quite different, or it is quite more extensive compared with the interpretation of the ratio. So there are 5 broad categories of ratios that we have. We have the performance or profitability ratios. We have short-term liquidity ratios, efficiency ratios, long-term solvency ratios, and investment ratios. So these are the 5 broad categories of ratios that we have in finance and accounting. So under the performance or profitability ratios, we have what we call the gross profit margin, we have operating margin, return on capital employed or ROCE, and then we also have the return on equity or the ROE. Then with the short-term liquidity ratios, we have 2 main categories. We have the current ratio as well as the current ratio as well as the quick or what we call the acid test. So let me just insert it there. Quick or acid test. Quick or acid test ratio. And under efficiency ratios, we have the inventory turnover ratio, we have the inventory days, receivable days, and then payable days. And under the long-term solvency ratios, we have the gearing ratio as well as the interest cover. And then lastly, we have EPS or the earnings per share, we have dividend yield as well as the earnings yield under the investment ratios. So these are the broad and the major categories of ratios you will see in finance and accounting. So we are coming to learn for each of these ratios, we are coming to learn how to calculate the ratio, explain it, that is, interpret its meaning, and then analyze it, learn how to analyze the ratio. So we are coming to start with the gross profit margin. Now the gross profit margin, the calculation is equal to gross profit, so our gross profit divided by our revenue, So that is the formula for our gross profit margin. Now what does the gross profit margin do, or what does it mean? What's the interpretation? The interpretation is often derived from the components of the calculation. So we know that to calculate for gross profit margin, it is gross profit divided by revenue. So let's look at revenue. Revenue is a very key component of this ratio. For this ratio, And we know that when revenue increases, it's definitely increases the profitability of a firm. So the higher the revenue of any business, the higher, all things being equal, the higher the profit that will be generated from that business. Now, and the same thing applies to a significant decrease in revenue. When revenue is decreasing or decreases, it also have dire consequences on the profitability of the firm. So it is very key that we analyze revenue, and revenue is mostly affected by some issues such as um, let's say if there is an increase in the sales volume due to maybe massive advertisements or marketing campaigns that are being undertaken. This will increase your volume, the volume of your sales, and hence your revenue figure, or your revenue base. And also, if there is an increase in the selling price due to maybe increase in the quality of your products, or you have decided to apply some differentiating features to your product which merit an increase in their selling prices, that can also increase your revenue base. And also, maybe the business introduces a new product or expands into a new market, that can also where there are no competitors in the market or for the product, that can also increase the revenue base of the business and hence increase the profitability potential of the firm. And the same can be thought of um, in terms of a decrease in revenue. So maybe you know, um, the business decides to discontinue a loss-making product. When that happens, revenue might decrease, all right, but it has also decreased costs, and so that might also lead to profitability in some ways, because cost has reduced, revenue has also reduced, but the product is making a loss, which means that costs have exceeded the revenue. So discontinuing that product would actually result in higher or greater impact on the business than before. Alright, so those are some of the few ways of analyzing our revenue. Then gross profit, we all know that gross profit is revenue less cost of sales. So for the gross profit, it's always affected by higher revenue or lower revenue, and a higher cost of sales or lower cost of sales. So those are some of the two things that affect your gross profit potential. Now, what does the gross profit margin do? So the gross profit margin, we're talking about the amount of, so we're talking about the amount of profit, sorry, amount, the percentage of profit um, that is generated per every dollar sale. So that is what the gross profit margin calculates. So we are talking about the percent of profit, the percentage of profit that is generated per every dollar sale. So how much profit do we make on every dollar sale or revenue? That is what the gross profit margin indicates. That is what it indicates. So um, the higher it is, the better, for the firm. So if the gross profit margin level of the business is going down, that is a very poor sign that the business is doing well. The business is actually not doing well. So that is how we analyze it. And then also there are many factors that impact the gross revenue, the gross profit margin, because there are a lot of things that impact revenue, as I have already stated. So we analyze ratios based on the components of the ratio. What is the component of the ratio? What affects those components of that particular ratio? This is how we analyze the ratio, and then we compare it with other things that are related to those components. Okay, so with revenue, for instance, we talk about selling price, we talk about advertising. So if the gross profit margin is increasing, perhaps the business is undertaking um, advertising campaigns that are increasing the sales base of the business, and hence it has increased the revenue, and which translates into greater or higher profits, and hence the gross profit margin would increase. So this is how we analyze financial ratios. And then the second ratio we want to look at here is the operating margin. Now the operating margin is not different from the gross profit margin, because they are all on revenue basis. So this one, as the name goes, it is operating margin, it is operating profit divided by our revenue, and operating margin or operating profit, with this one, the components in the calculation are operating profit and revenue. We have already talked about revenue, so let's look at operating margin or operating profit. Operating profit is revenue, is the gross profit less your indirect costs, or yes, your indirect cost or indirect overheads. Okay, your overheads. So that is our operating margin, and we are talking about how well the business has managed to control those costs, because the operating profit is gotten as a result of the those indirect costs being less from your gross profit. And so how is the business managing the overheads of the firm, okay, with regards to revenue generation? Okay, so that is how we interpret the gross profit margin. That's how we interpret the gross profit margin. Now, as with the gross profit margin, the operating margin is um, also follows the same trend, which means that the higher the operating margin, the better it is for the firm, and the lower it is, it's an indication of poor performance or a lower profitability of the business. So that is what we have there. Yeah. And so we should always see a logical movement. There should always be a logical relationship between the gross profit margin and the operating profit. If we don't see that logical or reasonable relationship between these two ratios, then it means that either we are not controlling our indirect cost well, which means that we are recording more overhead, or we are incurring more overhead costs than necessary. So we have to look into our indirect costs and see how that uh, plays out in our analysis, in our financial statements of our business. So that is it. Sorry, I want to change this to ratio. All right. Then the next one here we want to look at is the return on capital employed. Now, the return on capital employed is what we call profit before interest and tax. So PBIT divided by our capital employed. divided by the capital employed. Now, capital employed, since I will not be writing the interpretation, let me write. So capital employed is equal to, is actually equal to the we can say total assets. It's actually equal to total assets minus our current liabilities. Now, this formula is not the only formula for calculating capital employed, but I think it's the most simplest, because in every statement of financial position, you will see your capital employed. Sorry, you will see your total assets, and then you also see your current liabilities. So that makes it very easy to calculate. Now, there are other ways of finding your capital employed. You can use what you call, you can just have your share capital, you add reserves, and then you add long-term debt or liabilities. So you have your share capital plus reserves plus your long-term debt, and that will give you your um your capital employed. Or simply put, capital employed is total assets minus current liabilities, and that will give you your capital employed. So return on capital employed, as the name goes, we are talking about the um how much profit we are generating on the resources that have been committed to the business. How much resources that have been generated on the We're talking about the amount of profit that has been generated on the resources committed to the management of the business. So we have employed some resources in our business. How much profit are we making, or how much return are we generating on those capital that has been pumped into the business? So that is what this particular um, ratio is indicating. We analyze it by looking at our investment issues. We analyze our investment issues. So, for example, if there's an investment in a new plant equipment, for instance, and it is funded by an equity or debt, this will increase the capital immediately. That will increase the capital base of the firm. But unless the investment happens to be at the beginning of the financial reporting period, profit before tax for the year will not include a full year's profit on that investment. So our return on capital employed would generally fall generally fall. But if the investment in the plant and equipment is not financed by equity or debt, because maybe the firm has sufficient cash to purchase the equipment outright, there will be no effect on capital employed, because we are kind of reducing one asset to be able to purchase another. So that is also another way of analyzing the whole thing. And then also revaluation of assets can also have an effect on the capital employed. So the revaluation of an asset is an accounting adjustment. It's an accounting adjustment that does not necessarily affect the operating capacity of the business. It does not affect the operating capacity of the business, because let's say we purchased an asset or an equipment that costs right now we are in July, and the asset costs $4,000. Then by the year end, the asset has been revalued, or has a fair value of say $8,000. There has been a revaluation of the asset upwards of 4,000. Okay, so there is a revaluation surplus of 4,000 on the asset. Now, this 4,000 will not increase the operating capacity of the asset, and hence it will not increase our profit base. However, it will increase the total assets value, which is part of our capital employed, and so this will have an impact on the return on capital employed, which means that the capital employed is likely to fall because the capital employed is a denominator, and that will impact the return on capital employed calculation downwards. So that's a sum. And then another way of analyzing is through depreciation. Then we also have the return on equity. Return on equity is also calculated as the profits um, before tax. So let me just use my abbreviation. So it's going to be PBT, or profit before tax, divided by our equity. So that is going to be equity plus reserves. So we put this in brackets usually. So that is how we calculate our return on equity. Now the only difference between the return on equity is that this one uses our operating profit, or the profit before interest and tax. Now remember that profit before interest and tax is the same as operating profits. Okay, it's just a different name. It's just a matter of presentation. Okay, so it's the same thing, but this one uses profit before tax, which means that it takes away the interest element. The same interpretation can be given to the two of them. So we are talking about, in this case, we are talking about the return on the resources provided by equity holders only. So with the capital employed, we are talking about both equity and then debt providers. Okay, all the resources that have been committed to the business. But with the return on equity, we are talking about only the resources provided by equity capital holders or shareholders of the business. All right, so that is it for performance or profitability ratios. And then we also have our short-term liquidity ratios. Now current ratio. Now with the short-term liquidity ratios, we are talking about those ratios that are used to assess the entity's ability to raise cash to be able to meet short-term payments when they become due. Okay, so how is the business, or how quickly is the business able to meet short-term obligations as they fall due? That is what we call the short-term liquidity ratios. So these two ratios, current ratio and quick ratio, are the two major short-term liquidity ratios that we have in finance. So current ratio is calculated by our current assets. So it's calculated by current assets divided by our current liabilities. Okay. Our current liabilities. So that is the formula for calculating our current ratios. Sure. Let's enlarge this. Now, what does this particular ratio measure? Now, the two ratios measure basically the same thing, and so they are actually, so let me quote that of the asset test ratio or the quick ratio. The quick ratio is measured or is calculated by the same current ratio. So I'm just going to do this, but in this case we want to look at only liquid assets. We are looking at just liquid assets, and so we will take away the least liquid assets, which is the inventories. Inventories are the least liquid assets you can ever have. So it takes away the impact of that. Takes away the impact of that. Okay. So that is the acid test ratio, and it is actually an improvement on the limitations of the current ratio. So the current ratio is and these two ratios, before I continue, are actually in expressed in ratios. So this is the result is actually is to 1. This is also actually always expressed as is to 1. So we have is to 1 like that. Alright. So let's look at the interpretation and then the analysis, how to interpret them and then also analyze them. Now, the current ratio measures the adequacy of how adequate our current ratios are in relation to our current liabilities. So our current assets, how are they adequate enough to cater for our current liabilities or to cover our current liabilities. Okay, so that is our current ratio. However, this has a limitation because of inventories, because of the inclusion of inventories in our current assets, as these inventories are mostly not easily convertible into cash. So with this ratio, we are talking about how liquid the business is. And when you talk about how liquid the business is, how much cash is the business having to be able to meet its short-term obligations or liabilities as they fall due. Okay. So if you include the inventories in our current ratio calculation, we know that inventory usually takes longer time to be converted into cash or to be sold, and sometimes even if they are sold on credit, and so we would have to analyze our receivable days, our inventory days, to be able to assess their liquidity level. Okay, so that is a limitation on the current ratio, and so the quick or the acid test ratio comes to correct that anomaly. It comes in to correct the anomaly by eliminating the slower moving item, which is the inventories. Okay, which is the inventories. Now, these ratios are actually analyzed as follows. So that is the interpretation. The interpretation is that they are actually interpreted in terms of how much assets, current assets, we have to be able to cover our current liabilities. How much current assets we have available to be able to cover our current liabilities as they fall due. So that is the interpretation, that's the meaning of these ratios. Now the interpretation, the analysis. So let's look at the analysis. With the analysis, we are seeing that when these two ratios are calculated and they are lower, it means they, and how do we know that they are low or high? We usually have, that is where the comparisons comes in. So we can compare it over time, or that is whether it is increasing or reducing over time. So let's say this current year compared with the previous year, or compared with the last 5 years, how is it trending? So that is how we know whether it is increasing or decreasing, or low or high. And then we can also compare it with an industry average. So with these two ratios, usually when they are 1:1, that is the ideal ratio. Ideal ratio is 1:1. So that is usually, but it depends on the industry. Some industries have higher short-term liquidity ratios and others have lower. So it depends on the industry, the business find itself. So it is worth noting that in an exam, you critically analyze your question or what the scenario, and then you determine what kind of business your um the scenario is trying to portray, and then you can determine your, but most of the time this ratios, the average ratio of the industry will be given to you, and so there's no problem with that. So what you are saying is that when you calculate your ratio and it is low, it means the business is having liquidity problems, which means that it might not be able to pay its short-term debts if before due. And at the same time, if the ratios are too high, it may indicate poor management of funds. A poor management of funds, and such an example is maybe there's too much investment in the working capital, on the working capital, because the working capital is what we use in everyday running of the business. So the working capital, that's the working capital. So if there is so much investment in the working capital, it is actually not good for the business in the long term, because such monies or that which has been invested in the working capital can be put in a capital investment which has a longer term return for the business. Okay, longer term and then higher term, higher investments in the long term. All right, so that is another way of analyzing it. Whenever you calculate these two ratios and there is a deterioration, you compare it with maybe prior figures, and there is a deterioration in the current ratio but not the quick ratio, it may be due to perhaps the inventory being obsolete, and inventory obsolescence can be linked to um, it can be linked to the inventory days, which we are coming to look at shortly. The inventory days. So if your inventory days are high, it means that we are not, we will come to that so we understand it. Okay. And where there is a deterioration or a fall in both ratios, where there is a fall in both ratios, this may raise concerns about your credit control and recoverability of receivables. Okay. How quickly are you receiving your receivables? That is causing your um your ratios to fall. Okay, and that can also be found in our receivable days. So we can see that when you are analyzing these two ratios, we make use of the inventory days, receivable days, as well as the payable days, because these three items forms part of our current assets and our current liabilities. Do you see? So whenever you are analyzing ratios, we always analyze them using the components that form the ratio. The components that form the ratio. All right. So let's quickly move on to the efficiency ratios. So with the efficiency ratio, the first one is the inventory turnover ratio. So first of all, what is the efficiency ratio? Efficiency ratios are those ratios that are concerned with our current assets, how quickly our current assets are moving in and out of the business, how our current assets are moving in and out of the business. So that is what the efficiency ratios are all about. Okay. So the first efficiency ratio we want to look at here is the inventory turnover ratio. Now the inventory turnover ratio is calculated as the number of times now the inventory ratio or the inventory turnover ratio is calculated as the number of times inventory is turned over each year. Number of times inventory is turned over each year. So it is calculated as cost of sales. So we have cost of sales divided by our inventory. So that is the inventory days. Now let me actually input all the formulas so that we can move on. Then the inventory days is calculated by our inventory, divided by our cost of sales, so COS, and then we multiply the result by the number of days in the period, which is usually 365 days. Now the same applies to our receivable days. So receivables divided by this one, we are talking about revenue. So it's going to be revenue, receivable days, revenue multiplied by 365 days. And then lastly, we want to look at the payable days. We have the payable days, and that is payables divided by our cost of sales multiplied by 365 days. Alright, so we have the inventory turnover ratio, and this is talking about the number of times inventory is turned over during the year. Okay? The number of times inventory is turned over during the year. Now we are associating it with cost of sales because inventory forms part of cost of sales in the financial statements. So we know that to calculate the cost of sales, it is your opening inventory, and then you add purchases of inventory, and then you less your closing inventory. So inventory is all that forms our cost of sales, right? So that is why we associate it with our inventory. Then this particular ratio is impacted largely by the rest three items, and so we are coming to focus more or we are coming to focus our attention more on these three items rather than on the inventory ratio. Alright, so the inventory days, this is talking about the holding period or the number of days our inventory, the number of days it takes for our inventory to be sold out. Okay, the number of days it takes our inventory to be sold out. So that is what we call the inventory days. Okay. So it is the number of days it takes to actually sell our inventories. So the lower it is, the better, because when it is low, it means our inventory is fast moving. However, there are things that might result in other things that we might be looking at just in a few moments. Okay, but before we continue, if this is your first time on my channel, kindly subscribe to the channel, hit the subscription button, and then also make sure you like the video so that others can also benefit. All right, so inventory, when you talk about inventory, we are actually talking about three major things. Mostly we are talking about raw materials, we are talking about work in progress, okay, then we also talk about finished goods. Okay. Finished goods. So these are the three broad categories of ratios of inventories, that we have. Okay. So when your number of days, when you calculate your inventory days, and the number of days are this is analysis. So when you calculate your inventory days and the number of days are lower compared to maybe an industry average, prior period, a budget or something, it is a good indication. However, it might also have implications. For instance, when you have a shorter period, maybe due to fast inventory turnover, it means your inventory is generally efficient. Okay, maybe you are undertaking marketing or other activities that have made your operations very efficient, and hence your inventories are moving very fast. However, there is a risk of stockouts, and when there is stockouts, that might halt your operations. So this is how you analyze these items in the items of ratios. I hope you are getting the logic behind it. And then also If it takes longer period, if your inventory days takes a longer period, then it means that it may indicate an inefficient use of your inventory, okay, your resources, and that might also result in possible or the risk of your inventory being deteriorated or becoming obsolete, out of date. Okay, so that is another risk associated with low, or let me say, low movement of inventory or high inventory days. Inventory days. So this is how we actually, or even a higher inventory days can also be attributed to low market demand for your products. If there is low demand for your products, this would be reflected in your number of days the inventory is being turned over, and that will go a long way to affect your revenue, and this will have an impact on the profitability of the business. Okay, so this is how each of these items. Then receivables, the same thing. This is inventory. Receivables is talking about your debtors level. So receivable days, how long does it take for you to receive um, amounts that are due your debtors? How long does it take for them to repay you any amounts they have bought your goods on credit? Okay, so that is the receivable days, and we are associating it with revenue because receivables and revenue are the same. Receivables and revenue, or let me say, revenue is as a result of receivables. Okay, so that is it. And with this one, just as we have the inventory, an acceptable level or an acceptable number of days can be gotten maybe from the industry, or maybe you are making an overtime comparison. So when you have an increasing number of days of receivables, that can have an issue with your liquidity position. So you will have an issue with your liquidity position because your debtors are not paying you, and so you might not have the enough resources to be able to cater for your short-term obligations as they due, or you might not be able to pay your payables or cater for your payables and other things. So that might have an issue. Okay. Now, sometimes it is generally accepted that when your receivable days is 30 days, that is considered normal. Okay, it's generally a benchmark. 30 days, if it is 30 days, that is usually normal. That is a month. Okay, so that's the normal number of days. If it is higher, then it is too much. That one might have an impact on your liquidity position. And if it is too low, then that means that it is actually a good indicator, a good indicator of your for your business. All right. And if your receivable days are too high, then there is the chance of, or there is a risk that your your receivables might not be collected, and hence they will become irrecoverable. And that's why we have bad debts. Okay, so when you have a very high receivable days, it's like it is an indicator of the risk of your receivables becoming irrecoverable. Okay, that is a risk that you might want to avoid at all costs. Okay. And then also maybe sometimes you have extended, or you have extended your credit terms too high. you have a too high extended credit terms, and that might also impact your receivable days and make it very high. So to be able to improve your receivable days, you can introduce some settlements in discounts. So you can say that if you are able to pay within 15 days or 20 days after the purchase, you will be entitled to, let's say, a 15% discount of the gross amount, or the receivable amount, or the payable amount, that kind of thing. So when you introduce settlement discounts, this can actually reduce your receivable days and increase your receivables level. So this will increase your collection period, receivables collection period. All right. Now the payable days is the exact opposite of the receivable days. Is the exact opposite of the now payables is actually how long it takes for us to pay our suppliers. How long it takes for us to pay our suppliers. Oh yes, so that is the exact interpretation of the payable days. So we are talking about the number of days credit is taken by the company from its suppliers. Number of days your suppliers are willing to wait for you to pay them. Okay, that's how. So it is directly associated with the receivable days, in that the receivable days for the receiving company is actually the payable days for the selling company. The receivable days for the receiving company or the selling company is the payable days for the buying company. Okay, so these things are just the same. It depends on the perspective from which you are analyzing it. Okay, and then one is associated with cost of sales, because this is purchases. This is payables is as a result of purchases, as receivables is as a result of revenue. So that is it. So we analyze it in the same manner as we do. Then we also have the gearing ratio. We have the gearing ratio. Now the gearing ratio is calculated as, let me indicate my formulas first, and then after that I will talk about the interpretation, the meaning, and then the analysis. Alright, so our gearing ratio is usually debt over equity. Usually debt over equity. Some people also add debt. Some people also add debt to the equity again. So let me put debt plus debt in brackets. So instead of this, let me put this in brackets. Put it this way. This is an alternative. Okay, so we can have, and the debt we are talking about here is our long-term debt. And then the interest cover, we are talking about our interest. We are talking about our profits before, it's our profits before interest, and of course tax, divided by interest, divided by our interest, divided by our interest. Okay, so, and this interest is the interest payable in the statement of profit or loss. So that's the interest. Now the long-term debt you are talking about here, you are talking about all interest, all interest bearing, all interest bearing debts. Also looking at preference, also looking at preference shares, and we are also looking at long term. So let me do it. Debt includes so because of that, let me just remove it from my formula. So my formula here, then I remove it. Alright, so as I said, the formula is actually debt over equity, but you can also use debt over equity plus debt. And the debt we are talking about all interest bearing debts and preference shares, all interest bearing debt, and that includes long term borrowings or long term loans. Alright, so that is our gearing. Now, what is gearing? Gearing can also be known, it's also called leverage. It's also called leverage. So you can see gearing ratio or leverage So that is what, and it is talking about the relationship, as we can see from the formula, the relationship between the debt and equity, the debt and equity plus reserves of the company. What is the mix of debt and equity the business uses to finance its operations? That is what we call the gearing ratio. That is what we call the gearing ratio. Okay. Now we can say that a company is said to be highly geared if this particular ratio is very high. It's very high, and when you say it is very high, it means that a substantial portion of its capital, and when we talk about capital here, we're talking about debt plus equity. So a substantial portion of the capital in the form of the debt, which is the interest bearing debt, preference shares, long term loans, or borrowings, are very high. Are very high. So when this happens, it is actually not a good indicator for the business, because the interest is usually paid whether the business makes profits or not. And so if the business has high interest bearing debts, preference shares, which have um, um, fixed interest, and then also long-term borrowings, which are all carrying interest elements, this would have consequences on the profitability of the business, because that means that the business would have to pay higher amounts of interest whether there are enough profits or not. So if a business is very geared or is highly geared, it means that there must be enough profit to cover the interest elements of the debt, of the interest of the debt. All right. So and then the second one is talking about the interest cover. The interest cover. So we are talking about how much profit we are generating to cover the interest that is being generated on our interest bearing debt, preference shares, and other long-term borrowings. Okay, so that is how we, so this is closely related to the gearing ratio. So if the business is highly geared, it means that your interest is going to be very high, and so that must that must prompt you to increase your profits to be able to cover your interest, now this, the rest of the ratios under the investment ratios, we have the earnings per share, dividend yield, and then now these are actually valuation ratios. They are ratios that are used to value a business. So we will be covering this in more detail in another video which I'll be making on business valuation. So we can use that to actually understand them more. So, but let me give you the formulas for EPS, dividend yield. So our EPS, or the earnings per share, is equal to um our market price per share divided by our PE, what you call the PE ratio. Our PE ratio. So this is how we calculate PE ratio. Now this is a matter of change of subject. So let me also actually do it like this. So earnings per share is equal to market per share divided by the PE ratio. So to find your PE ratio, you just do change of subject. So the PE ratio is actually the EPS divided by the MPS, or the MPS divided by the EPS, that kind of thing. So whatever you want to find, you can use this equation to find it, and then you go. Then the dividend yield, as we can see, is equal to your dividend divided by the market price per share. The earnings yield follows the same trend as the dividend yield. So its earnings per share, its earnings per share is EPS divided by our MPS. So that is it. Now I'll be covering these ones in our business valuation video. So this is how we calculate them, and they are indicators of the EPS, or the earnings per share, talks about how we are projecting the business to grow in terms of the share price. Okay, we are trying to value the share price of the business and see how it's going to grow in the foreseeable future, the growth prospects of the shares of the business. Okay, so if I should buy 1,000 shares in this business, how much should I expect the business to grow in the next 2 years, in the next 3 years? That is what we call the EPS. Then the dividend, and then the earnings. The dividend is usually used by shareholders or investors to assess the return on their shares in terms of dividend, the return on their shareholdings in terms of dividend. Then the earnings is not different from that one. Is talking about their profits, the share of their profits, which is actually also in terms of dividend payments. So these are investment ratios that investors use to assess the growth prospects of the business. Alright, so that is it for this video. In our next video, we are coming to look at how to actually use these ratios to analyze financial statements. So this has been a very long video. Financial statement analysis is actually a very key aspect of business analysis. because everything we do in finance, in accounting, is geared towards um interpretation, and then using that interpretation to make decisions. And ratios um, form a very key aspect of that process. So to be able to forecast your business, financial modeling, which we have done already, you will see that we use ratios to actually model the financial statements into the future. And so ratios are a very key aspect of everything that finance and accountants do in everyday life. And in the exams, you will be asked to analyze, interpret, and analyze financial ratios. Now, um, less focus is usually given to the calculation, and much of the focus is on the interpretation and analysis. And so, even if you haven't actually gotten anything from this video, at least one thing you have gotten from me is that when you are analyzing the financial ratios, always look at the components of that ratio and see what factors, what business factors, what accounting policies affect, or what business policies, accounting policies, and strategies actually affect that component of the ratio, and then you analyze it from that angle. So that is it for this video. In our next video, we are coming to look at a financial statement. I actually have the financial statements here. So we are going to use these financial statements to calculate these ratios, and then we'll see how we can interpret it. Alright, so thank you very much for your time, and I will encourage you to subscribe to the channel so that you can follow me as we learn together. Alright, so thank you very much, and I'll see you again.